Hello everyone, this is Moniza. I welcome you all to my class. Today we will be having a discussion regarding IAS 10, that is International Accounting Standard number 10, events after the reporting period. Let us first have a look at the definition provided by IAS 10 in regards to the events after the reporting period. IAS 10 tells us that all those events, favorable or unfavorable, that do occur between the end of the reporting period date and when the financial statements are authorized for issue does come under the scope of IAS 10. In order to understand IAS 10 thoroughly, we do need to be cleared about some of the highlighted points of the definition. The first highlighted point is about events. At this point, we do need to consider a distinction between an event and transaction, because IAS 10 covers the details regarding events, not the transactions. Then there are some important dates in regards to the reporting of the financial statements. We do need to be clear about that as well. Generally, we do know that the financial statements of the organization are prepared for the period of 1 year. So that time period falls in between start of the reporting period and at the end of the reporting period. Then there is a time period when the financial statements are authorized for issue. Who authorizes these financial statements for issue? The board of directors. Once the financial statements are being prepared by the accountants and all of the relevant persons, they are reviewed by the board of directors. And after getting satisfied, they do authorize the financial statements for issue. Because fundamentally, it is a responsibility of the management of the organization to prepare the financial statements and to make sure that the financial statements are giving a true and fair view of the actual position of the company. So IAS 10 tells us that all of the events which are happening in between the end of the reporting period date and the date when the financial statements are authorized for issue by the board of directors does come under the scope of IAS 10. Then a time comes when the shareholders meeting is being conducted. And that is a time when the financial statements are presented to the shareholders of the organization. There can be some events which can happen in between the time period of the shareholders meeting and the time at which the financial statements are authorized for issue. But those events are not covered by IAS 10. Now let us have a look on the distinctive points between events and transactions. As far as the meaning of event is concerned, we do say that all of the incidents or occurrences that relate to the business or have an impact on the business of entity is said to be as an event. But on the other hand, those events which have an immediate and measurable monetary impact on the books of accounts of the company are said to be as transactions. The point of distinction is measurable monetary impact on the books of accounts. The second point of distinction is about exchange. As far as events are concerned, all those events other than transactions do not involve exchange of value or resources, whereas transactions do involve the exchange of value of resources. The third point of distinction is in regards to measurability. Transactions are measurable in monetary value. But as far as events are concerned, all those events other than transactions are not immediately measurable in monetary value. As far as the impact on business of the event and transaction is concerned, The transactions have immediate monetary impact on the finances of the business. When the transaction is going to happen, we will be seeing an immediate monetary impact on the finances of the business. But this does not happen in the case of events. The impact can be seen in the future, which can be more far-reaching. The events do not have an immediate monetary impact on the business. So there are some points of distinction between events and the transactions. Now, IAS 10 has two main objectives: to prescribe that when the entities shall adjust the financial statements for the events, and what disclosures an entity should give. Now let's see what are adjusting and non-adjusting events. If there are any kind of adjusting events happening, we need to adjust the financial statements to reflect the event. But as far as non-adjusting events are concerned, we do not need to adjust our financial statements in regards to the non-adjusting events. But a disclosure to the financial statements in regards to the nature and monetary impact of that event can be given if the event is material. Now let us have a look at what are adjusting events. Adjusting events are all those events that provides the evidence of the condition that existed at the end of the reporting period. In other words, these events might happen after the end of the reporting period, but they were the result of something already in existence. And if we identify such event, what should we have to do? Obviously, a journal entry shall be made in order to adjust these events in our books of accounts. Our financial statements needs to be adjusted in order to reflect that amount, which is happening in between the end of the reporting period date and the date at which the financial statements are authorized for issue. And that particular event is providing an additional evidence of the conditions existing at the reporting period. So these events, basically adjusting events, these can happen after the end of the reporting period, but they were the result of something already in existence at the date of reporting. For example, settlement of the court case and a liability is being paid in the form of some penalty. And this settlement confirms that you had an obligation existing at the year-end reporting date, and a provision should have been recognized in line with the IAS 37, provisions, contingent liabilities, and contingent assets. But you haven't done that because obviously you got an information, you received an information after the reporting period ending date. So once you are settling a liability, you have to adjust it in the financial statements. Then if, for example, your client, your customer goes bankrupt after the end of the reporting period, and it indicates that the client's credit was impaired actually at the end of the reporting period date, And you should have reflected this in the credit loss calculation. But you have actually not did this. So what you have to do now, you have to adjust your financial statements in regards to that. And if, for example, if there is any discovery of the fraud or error, and this is typical event showing the financial statements are not correct, and the financial statements need to be adjusted, then this is an adjusting event, obviously. You need to reflect this in your financial statements. Then let us have a look on the non-adjusting events. Obviously, non-adjusting events do arose after the end of the reporting period. But they did not exist at the end of the reporting period. Which means that these are going to concern the conditions which did not exist at the reporting date. They are happening in between the time period of the reporting period ending date and the time when the financial statements are authorized for issue. But they are concerning the conditions which did not exist at the reporting date. What is the treatment of non-adjusting events according to IAS 10? We do not need to reflect these non-adjusting events in the financial statements according to IAS 10. The financial statements will not be changed in regards to the non-adjusting events. But if these non-adjusting events are material, then a disclosure regarding the nature and the monetary impact of those events has to be given, has to be disclosed in the notes to the financial statements. For example, if there is any kind of natural disaster happened after the year ending date, and the nature of that natural disaster is a material one, then a disclosure needs to be given in the notes to the financial statements. But for example, if that disaster was not having any kind of material impact, the amount is not a material one, then simply we do have to ignore it. We do not need to disclose it in the notes to the financial statements. IAS 10 events after the reporting period does gives us the guidelines regarding the impact of the going concern issue. If, for example, some events have happened after the reporting period which are impacting the going concern of the organization, some event has happened after the reporting period by which we are observing, we are having this thing in our mind that maybe the business will not be able to run as a going concern, then the standard requires us to adjust the financial statements to be presented on the breakup basis. Even if the conditions were not existing at the reporting date. If something has happened after the reporting date, which is now giving us an idea that maybe our business will not be running as a going concern in a foreseeable future in the next 12 months, then the standard IAS 10 requires us to adjust the financial statements to be presented on the breakup basis. And if for some reason this is not happening, we were not able to adjust the financial statements to be presented on the breakup basis, then a disclosure is needed to be given. I hope this thing is clear to you people. There are some examples given in regard to the adjusting events. As I've told you earlier, for example, if there was a settlement after the reporting date of the court case which confirms a year-end obligation, which gives us an idea that the condition was already present at the year-ending date. But the event which has happened now is confirming it's present at the year-ending date, then we have to adjust it. We have to change our financial statements to reflect that event. Then if, for example, we have received any kind of information after the reporting date that indicates that an asset was impaired at the reporting date, then we have to adjust our financial statements. The asset was already being impaired at the reporting date. We are confirmed about that thing. But we have received the information after the reporting date. Then it means that we have to adjust that particular event. And for example, if our customer has become bankrupt after the reporting date, that confirms that the year-end receivable is recoverable. The conditions were already existing at the year-ending date. But its evidence has come after the reporting date. Then what do we need to do? We have to adjust it. Some examples related to the non-adjusting events are already given in this slide. What is an impact of non-adjusting events? Obviously, non-adjusting events will not be reflected in the financial statements of the organization. But if they are material, a disclosure will be given in the notes to the financial statements about their nature and their monetary impact on the business. And if they are non-material, we have to ignore them. For example, if management has a plan to discontinue or significantly curtail its activities in major geographic segments, it will be having a major impact on the business. It can be a material event. But because no evidence was present, no condition was present at the year-ending date about this event, it's a non-adjusting one. We do need to disclose it in the notes to the financial statements, but the financial statements will not be adjusted because of that. Then if, for example, any initiation of a major litigation against the company is arising out of the events that occurred after the reporting period, even if it is material, it will be a non-adjusting event because the conditions related to this event were not present at the reporting end date. If the conditions were present at the reporting end date about this litigation, then obviously we do need to adjust it, otherwise not. Then if, for example, generally speaking, if any kinds of dividends are being announced by the company for its shareholders, these can prove to be the major example of the non-adjusting events. Except in the case of preference shareholders, because the dividend which we have to pay on the preference shares, obviously, that is a kind of a liability. But generally, any kind of dividend declared after the reporting period ending date will be a non-adjusting event. The non-adjusting, non-material events can be purchase of an asset. If we have purchased any kind of asset and the amount is not a material one, it will be a non-adjusting event. Then the destruction of asset. If any kind of asset is being destructed by the result of any natural calamity, for example, any kind of natural disaster has resulted in the destruction of an asset, and the amount is a non-material one, then the conditions were not already present at the year ending date. It will be considered as a non-adjusting event. And if the amount is non-material, we do not need to disclose it as well. We are going to ignore it. Now here is a question for you people. You can test your understanding with the help of this question. I have taken this question from Financial Accounting Book of ACCA, F3. The question is, which of the following are adjusting events for big company? The accounting year end is 30th June 2006 and the financial statements are approved on 18th August 2006. You can read this question and you can tell me the answers in the comment box. I will be discussing the answers in my next lecture. So my dear students, this is all for today. If you do have any questions, you can just ask me. So today we have successfully completed our discussion in regards to IAS 10, events after the reporting period. Thank you so much.